Good day, fellow deal makers. Hey, if you happen to have a large pool of capital and you're looking for some allocation conversations, this might be a an episode you want to pay attention to. So, Mr. McCoy, welcome to the show.
Hey, thanks for having me. It's good to be on.
Yeah. So, did I get that right in my introduction? Like, this is you're in the world of allocation and finding cool deals. Is that what you do?
Yeah, so I'm called a number of different things, third-party marketer or a placement agent. At the end of the day, I'm a glorified salesperson. But I think that the people I reach out to, I'm in the investment world. I'm not typically reaching out to your lawyer, your dentist, trying to get them to invest in the latest hot stock. I represent hedge fund managers, venture capital managers. I've even represented a crypto asset hedge fund. But I represent these kind of unique investment strategies that cater to larger pools of money. So I think endowments and foundations, pensions, family offices, folks like that who have a lot of money and need to make good returns. And I try and introduce them to folks who can hopefully pull that off for them. Yeah.
Yeah. How in the world? Oh, first of all,
Yeah.
does your family kind of would they say the same thing if I was like, what does your uncle do or what does your husband do or some, would they say the same thing or what would they say?
I tell them to say raise money for hedge funds, and that's probably the simplest explanation.
Yeah.
It gets a little more complicated than that, but yeah, for the most part, they know what I do. But yeah, a lot of variety of things we do around here.
Sounds cool. All right, like let's go backwards. How'd you get into this job? It sounds super cool.
You know what? I had a buddy who was starting up an investment strategy. I actually am probably one of the few guys who came into finance from being a 3D animator. I mean, my background is diverse, and I'm one of those guys who never knew what he wanted to do when he grew up. Went to college for 6 years, had six different declared majors. My final year, I took a finance class, and that was like, oh my God, this is awesome. I could totally do this. But, somewhere along the lines, around the sixth year, you want to get the heck out of college.
Yeah.
So yeah, so I did a number of things. I was a 3D animator. I produced video games. I went on to produce websites, and I was getting a little burned out, to be honest with you. It was one of those situations where my buddy came to me and he's like, you're in a job where if you want to make another dollar, you got to work another hour. And he's like, you should come over to finance because, whether I manage $1 million or $100 million, it's basically the same amount of work. It's just one, I make 100 times more. And, as someone who was putting in 80-hour weeks, I was kind of like, I'm intrigued, sign me up. And so I had a buddy who's a really smart guy, and he started this investment strategy that would hopefully appeal to these large pools of money, endowments, foundations, folks like that. And so I agreed to kind of quit my job. I'd set myself up a little bit where I could try something new. Switched from producing websites. I did AMD.com and all these. I was doing really cool stuff. But at the end of the day, my buddy trusted that I'd be able to figure out finance, having not gone the traditional route that a lot of other people did. And that ended up being a blessing rather than a curse in a lot of ways. I didn't have a lot of bad habits that a lot of Wall Street people have. And I didn't have to kind of slum it through, smiling and dialing and trying to, sell someone a stock or something. But he convinced me, hey, this is the approach I'm taking. It's kind of unusual, but he handed me a book written by the guy who runs the Yale Endowment, the chief investment officer of the Yale Endowment, a guy by the name of David Swenson. And he had written a book that was essentially a guide for other endowments and foundations, how to run money the Yale way. And if you kind of reverse engineered this book, as far as like what Yale looked for in an investment manager, you could design an investment strategy that is exactly what they want. Starting from scratch, it was essentially a cookbook for how to create something that these folks were interested in. And so I read the book, I struggled through it. Like I said, not a huge finance background, but it was written, I could understand it. And at the end of the day, I was like, you know what, I believe him. I think this is great. I think we can do this. Little did I know, I mean, absolutely ridiculous to think that we could do this. So this manager was managing about 300,000 under management and had a year track record. Which in my world was like, wow, that's a lot of money. And, things are going great. His first year track record was phenomenal. Little did I know that these people won't take calls until you're managing $100 million and have a, 3 to 5 year track record. But it's one of those things, a little naivety, a little persistence. If you don't know what you can't do, sometimes you just go do it. And so I hooked up with him, and it was a slog. And not knowing what I didn't know, I signed up to be commission only, and it was like a year and a half of not getting a paycheck. But I knew we were getting close, and I firmly believed that I could do it, and I firmly believed in him and that he was doing the right thing, and our meetings were productive. I mean, I could tell we were close, and so right around a year and a half, I started landing some clients, and some big $10 million checks were coming in, which was great to go from never having done this to landing $10 million, $20 million, $50 million checks. Was exciting. But yeah, starting off, I mean, if I was to advise someone else, I would not say take on a manager with a 1 year track record and 300K and go for it. Like, I kind of describe it as like walking up to Spielberg with a VHS tape. That's kind of how I felt.
Yeah.
But I think people were amused by us. Two guys from Nebraska. They knew we weren't slick Wall Street people. I mean, we did not come across as slick, but we did come across as honest and passionate and trying to do things the way that they wanted them done. And I think they were like, these people are trying to meet us at what we want. And yeah, it worked out. So.
This is so cool. From building websites to raising, I'm seeing over 150 million.
Yeah, well, at this point, over a quarter billion, probably. Yeah, I've raised money for different managers now over the years. A lot of them have a similar investment philosophy because I've kind of found what works and what folks are interested in. But yeah, no, it's a lot of a lot of rejection. High school dating prepared me well for this job. It's 99% of the time I'm emailing into the void or leaving a voice message that I know is never getting answered.
Yeah.
But the people who are interested in this stuff are really interested, and when I can connect with those people, it's great.
And when you were in high school, building websites probably wasn't the hottest career.
No, it's crazy. When I went to college, I was
Yeah.
actually a 3D animator.
Oh,
That's
that's
what I
cool.
wanted to be. And at the time, that career did not exist. Like I was one of the few guys in the state of Nebraska where I grew up that could do this stuff. I actually had the TV stations coming to my house to plug into my equipment to do some special
Wow.
effects because they couldn't, handle it at their TV station. And so, yeah, it was really cool. So I actually paid my way through college. I produced big screen animations for like football stadiums, like the Atlanta Braves, the Carolina Panthers, Nebraska Cornhuskers, and I sold packages. And if you went to see a football game and there was an animation on the big screen getting the crowd all excited, it might have been something I did if it was in the 90s. But the job didn't exist. Nowadays, it's like, oh yeah, graphic designer. I mean, it's split into 20 subdivisions
Right.
of what you can be. But back then, they didn't even have courses. I was writing for magazines. I was teaching other people. I was essentially, paper blogging back in the 90s. But I was kind of an expert on animation and written up in magazines and stuff. But my college didn't have any courses even remotely compared to what I did. So I got a
Yeah.
degree in broadcasting and advertising, amongst other minors and whatnot. So.
Yeah. And now that career is absolutely massive. Do you ever look back and you go, man, what would life look like if I was doing this for, George Lucas or whoever, right?
It's funny. My job choices out of college, I had a choice to go work for Steven Spielberg's Amblin Entertainment. They were working on a show called Sequest, which at the time had some cutting edge graphics using the computer I did. And so I almost moved to Arizona. I ended up moving to Iowa. Big cultural shock from Nebraska, as you can imagine. No, it was the same
Same
cornfields
thing.
everywhere. But there was like a company with like 150 people working on video games and movies. We worked on like Blade the movie, and we produced video games for Pixar and Disney and Toy Story. I actually handled a lot of the Hasbro and Warner Brother accounts, so I did like Looney Tunes video games. It was awesome. Creative people everywhere: artists, animators, programmers, musicians. It was a dream job. The people were so exciting that no one ever left the office because that's where all the cool people were in Iowa, was in our little building.
So cool.
So yeah.
So then, from the creative side, everybody's like hip and cool, flip flops and, like weird color hair. And then you get
Yeah,
into finance for pension boards and endowments,
yeah,
where everybody at the board seat looks the exact same, right? Very
yeah.
culture shock.
It definitely an upgrade in the attire. The hours were probably. I mean, I went from working long hours, but no one in that industry, they didn't care if you rolled in at 10 a.m.
Yeah.
Because everyone was working till 2 a.m.
Yeah.
But yeah, no, it was yeah, it's hard to find a bigger 180. But it was funny, and I really missed the creative aspect. But I'd kind of grown out of it. I'd gone from doing the work to managing the people that did the work to managing the people who decided on the work. And next thing you know, I was staring down and I'm looking at spreadsheets with 30 tabs open, managing a website, and I'm like, this is not where I started off. So at that point, it was time for a career change.
Yeah. So taking the leap though, a
Mhm.
year and a half without collecting a paycheck, how did that go?
That was tough. Yeah, because like I said, about halfway through that process, I started to realize that, this is not what people are looking for as far as credentials.
Yeah.
We weren't exactly giving pension funds the warm fuzzies when we walked in with two people managing the amount of money we were.
Hmm.
So yeah, it took a while, but I knew I was close, and I think it would have been one thing if I was getting rejected all the time, but I was getting meetings, and I could tell people wanted to invest. They just it takes a brave investor to invest in a small upstart emerging manager.
Yeah.
They all say, "Oh, we're contrarian. We're doing things different because that's what we need to do to get different results." But then what you find out is that 90% of the people who say they're contrarian are waiting for the real contrarian to jump in first, and then they'll follow along.
Yeah. I'm a
Yeah,
secondhand contrarian, right? Like you go
yeah,
first, then me, right? Like you prove it
yeah.
out. And that's what you experience kind of in that world. I was on a pension board for the fire department. And
Oh
we
yeah,
we would have people come in and pitch, and we had to go like study actuarial tables, essentially like when is Josh gonna die, right? And then
yeah,
people would come and pitch. So that would have been you coming and pitch to the board, right?
yeah. A little bit. Pension funds are tough, and especially fire and pension. And I'll tell you why. It's in part because they have people on their boards who are firemen and who aren't necessarily well versed in these subjects.
Yeah.
And so they're pitching. The people they go with tend to be B plus managers. Very safe, very conservative.
Yeah.
No one on a pension board is going to get fired for going with Goldman Sachs or whatever.
Yeah.
However, the people that I pitch are definitely, you've never heard of them. They're off the beaten path. And so I'm looking for allocators and boards that are on the cutting edge. In a lot of cases, you'll find this at university endowments.
Yeah.
They have people they're teaching the latest and greatest things. They're all doing tons of research on what works. And because, like I said, the Yale endowment kind of was an innovator and produced incredible returns, a lot better than pension funds were doing. A lot of people mimicked this model and were trying to do what Yale was doing. And so I cater to those people, endowments, foundations. But yeah, if there's a pension fund, I typically, there's so many people involved that the quirky managers I bring them, they're not going to make it very far. But that's okay.
Yeah. The super fascinating what you did, and you probably learned this from the world of marketing. What are they looking for, right? If I was to go pitch at Yale, why don't you read the book at this is exactly how we do things, reverse engineer it, and give them exactly what they want? Do you think a lot of cap raisers or allocators, do you think they miss that step?
Yeah, I think so often I get managers who are like, "Hey, I've come up with the greatest thing, and this is the best way to do it," and then you're going to try and convince them that this is what they need. And it's better sometimes if you know what they need and then you bring it to them.
Yeah.
Yeah, it's a tough situation because a lot of times people are trying to do things different than what the allocators are used to, and sometimes that's a great source of generating returns. But then you have two problems: you have to educate them, and then you have to convince them. And honestly, with the strategy that I was doing, because people hadn't seen these small. The managers I represent tend to focus on smaller stocks, micro caps, small caps, and a lot of people at that time were scared. They didn't. weren't familiar with the asset class. They associated it with scams and penny stocks and oil drilling. But there's thousands of these microcap companies. I mean, Netflix was a microcap company. Monster Energy drink was a microcap company at some point. And so, it's a great playing field. The microcap space, A, I had to convince them this was a place to play, and then B, this is the manager, you need to do it. Yeah.
And if you had to add an extra step, I have to educate you, convince you, and then convert to dollars.
Yeah.
Those are a lot of steps. So you try to find people who are kind of doing something similar, research, innovation, right, in these universities, and go, hey, we got something that might be a good fit based on what you're doing.
Yeah, and and this book wasn't exactly prescriptive down to the exact strategy. I mean, Yale was saying, hey, we're looking for managers who are small, who are focused on niche markets and specialized in those areas, and who are willing to close and not take much money and close their doors so that they can continue to find success in the area they're looking at. The problem with investment managers is size is the enemy of results. You look at someone like Warren Buffett, and he's like, hey, if I had $50 million, I could double it every year. He's like, that's no problem. But when you're sitting on, tens of billions of dollars in cash like he is, his opportunity set is really tiny. He can only buy major companies. And so he's somewhat limited in his opportunity set. And so one of the appeals of, like, for example, a lot of the managers I work with, I've kind of carved a niche where I represent these microcap managers. And now endowments and foundations will call me and say, hey, do you have any interesting microcap managers? This is a space we're interested in. And microcaps as an asset class are fascinating. It's one of the best performing asset classes. It's outperformed, small caps, mid caps, large caps, bonds, whatever, over time, over the last 100 years, if you look kind of historically. There's tons of opportunities. There's thousands of companies that are overlooked. There's less competition. My guys are not competing with the Warren Buffetts and the Howard Marks of the world. And that's what you want, is you want a great playing field. If you're going to be swinging for home runs, you'd rather go down to the Little League field than, go to Wrigley. So, yeah, and that's what my guys do. I try and find, heavy hitters and, who are playing in a Little League field. The problem is that they can't take much money. They have to remain small. And from a comfort level, if you're a pension or one of these big pools of money, you'd love to see a team of 10 people and a compliance department and a marketing department and all that. Sure. And these people are working out of their houses, oftentimes, which, by the way, now is cool again. So that worked out well to my advantage. Most of my firms, would not be the time. They sit around and read all day, stocks stuff, and they don't need a big fancy office with chandeliers in the waiting room. So it worked out well for my guys that, COVID happened, I guess, because now it's okay to work from home. And they were doing it beforehand anyway. And I've been working from home for 15, 20 years. So
sweet. So as you're doing this, what does a typical day look like for you?
So I'm reaching out to a lot of folks. I will, these networks, LinkedIn is invaluable. I can find people who've worked at some of these endowments or foundations who ascribe to this philosophy that I know that appeals to them. And so I'll often try and find, a new college or university here, reach out to them. It's like I said, it's a long drawn out process of trying to get their attention because they have a lot of people trying to get their attention. If you're managing billions of dollars, you have a lot of people coming to you saying, hey, give me some of that. And I'm one of those guys. And so to be able to stand out, I've been fortunate in that, the managers I've represented, the number of them in the past, they've all worked out. I haven't had a dud yet. And so that goes a long way in that, no one's ever been burned by a manager. I've been put with them. So you build up a little bit of, capital, reputation capital there. And so, yeah, getting on their radar is tough. But then, an ideal day is like I'm on a call. I'm introducing an investment manager to a client that, loves them. This is what they're looking for, because the guys I represent, the folks I represent, are hard to find. And the other problem is because they close early, let's say they get 150 million in assets, they'll close shop and not advertise, not market. And the people who got in are the people who got in. And so a lot of times you'll hear about a great manager, but they'll be closed. And so I try and find those people before they're closed. And what's nice is don't have to look for investment managers. They come to me. I've helped enough people close that they're like, hey, you're the guy who's taking people from $1 million to $150 million or whatever, and then we close. So I have people reaching out to me, sending me their quarterly letters. I've got a farm team of a couple dozen of these similar managers. And so when it comes time for me to pick up a new client to represent, I don't always have a choice. I mean, not everyone wants to work with me. I mean, you have to give up some of, the rewards in order to, share that. But a lot of people are more than willing to do that because it is such a grog, and especially the early money is so hard to get in investment strategy.
So how do you get paid for this? So I'm a hedge fund manager. I'm quirky.
Yeah.
I'm cool. I want to raise, I've raised $1 million, but
Yeah.
let's get to 25, right?
Yeah. Okay. So typically what I would say is I'd like to see, at least 5 million under management. I'm not as foolish as I was before. I'd like to see a 3-year track record because that's kind of what institutions typically kind of require to at least get a feel for how you've been able to do. It's great if I can see how you've done in a market downturn, a 2008 situation or a COVID situation, because everyone wants to know. Everyone looks great in a bull market when tech stocks are flying and you can do no wrong. I mean, look at Wall Street bets. But yeah, so it's great if we can have someone who's gone through a bit of adversity, and I can see that. But yeah, so I look for that. I look for, like I said, there are certain things. I look for, are you focused on a niche, like an area where you can specialize and be better than everyone else. Mm-hmm. And then also I look for concentrated managers, which is a big thing. Concentrated managers, so their portfolios, this is not your typical Vanguard or Schwab portfolio with hundreds of companies. The managers I work with will invest in 10 to 15 names, which is, as you can imagine, somewhat risky, especially when you're in these smaller, more volatile names. So I look for people who are concentrated, because I mean, my philosophy is, and it's kind of Yale's philosophy, is that why would you put money in your 50th best idea? That's not what we're paying people for, right? So I find a manager like that who's got a nice, a great track record, who's doing things the right way, a good solid investment philosophy, some money under management, friends, family, fool money, as we call it, the initial people who get in, kind of give them their start. Mm-hmm. And then the way my pay structure works is there's 3 variables. Usually there's some kind of retainer. So, just kind of to keep the lights on and allow me to create presentation materials for them and enter their information in database, just some basic stuff that has to be done. Yep. And then typically I get paid a percentage of whatever they make on the money I bring them for a period of time. So the standard structure is I would make 20% of what the manager makes for 5 years from the time I land that client.
Gosh, that's awesome. Well,
so I mean, from their standpoint, they're like, I'm making 80% of money I would have never made, and I don't have to do anything. I mean, they have to do stuff. They have to be in the meetings when I call them and pitch and do the song and dance. But for the most part, these are smaller firms. They don't have the budget for marketing. I mean, a lot of people, the bigger firms would hire someone internally, pay them a reasonable salary. Right. For me, they're willing to give up a little more on the back end because they know they're going to be making money if I'm making any money. So it works out well. Incentives are aligned.
Yeah. What licensure or what kind of regulations do you have to work through? Because that's probably a question that people have. They're like, how do I pay you? And how do we work this thing out?
Well, and it's amazing how many people are doing it illegally too. Yeah. So this is the part of the conversation where I have the disclaimer that says nothing I say is investment advice and everyone's investment situation is unique. All of those disclaimers need to be said because I'm a registered broker. Yeah. So that means I've passed my Series 7 and Series 63. And that means I am allowed to market securities and sell securities. And a hedge fund is technically a security. And so I have those licenses. I also have a Series 65 license, which allows me to work with investment advisors. There's a distinction between brokers and investment advisors. Investment advisors have a fiduciary responsibility to do what's in your best interests. Brokers only need to do what's appropriate. All these Yeah, the compliance world is a nightmare. I'll be honest with you. For every page I send out of information, I usually have a backside to that page that is nothing but disclaimers, warning you of all the things that can go wrong with the investment I was just telling you was great.
Totally.
And so yeah, so there's a lot of that. But yeah, Series 7, 63 to be a registered broker, and that is if I want to get paid a percentage of the management fee. If someone, you know, makes a deal and says, "Hey, I'm going to bring you this guy, and you can pay me a finder's fee or a percentage or whatever." Technically, that's a no-no. And if they lost money on that investment, they would have to make them whole if they didn't go through the proper channels.
Totally. All right. So I
Yeah.
laughed because it's amazing. The two most common messages I get on LinkedIn, and I'm not a broker, I'm a real estate
Yeah.
broker. Okay.
Okay.
So the two most common messages, congrats on the new business, right? Because I've started a bunch of startups and businesses and
Yeah.
such. And then I've had jobs when those failed. And then the second message is, will you raise money for us? And when I start talking with them, I go, listen, I am not an investment banker. I am not a registered broker. I'm not a broker deal. I do not have those licenses. I've interviewed the Office of Financial Regulations, and they gave me the guidelines on what I'm allowed to do and not allowed to do. And they go,
Yeah.
but we could pay you this way. And I'm like, no, 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 no. I can't do it yet. One day,
Yeah, and
maybe.
back in 2017, it was pretty funny because crypto was taking off, and I was actually representing a legit hedge fund that was, properly registered, and but I had dozens of people coming out of college from, smart guys, Stanford, MIT. They all wanted to get into crypto, and they were doing everything somewhat illegally. The other thing about a hedge fund in particular is depending on how it's structured, you're not allowed to advertise it. Hedge funds can only be purchased by what are called accredited investors. So people who make more than 200K a year, who have more than $1 million in net worth. And there's even a qualified investors, which is a step above those folks. But yeah, so you can't, just go onto a website and announce our great performance and talk about things. If you're a hedge fund, a lot of them find ways around it and still do. But technically, yeah, if you have a website, it's supposed to have a password, and only the people who are investors can get in, and only people who you've had a previous relationship with can become investors. It's onerous, to be honest with you, and they're trying to change the laws. The Jobs Act that Obama passed a while back came up with some new interesting Reg A, Reg A plus ways that average folks can get into new investments and things that are a bit riskier. But investment protection is the name of the game, and you don't want people to do really dumb stuff. And in crypto in particular, people could do a lot of dumb stuff because they weren't being watched. Made a lot of money. People lost a lot of money. It was interesting.
And for this game that people are playing on how to do these kind of things, everything is all good until someone loses their money. Then they work their way backwards, right?
Yeah.
And you've been doing this. How long have you been doing this?
Since early 2000s, so 2003, I'd say.
Okay, so you made it through. You made it through the 08, 09, 10 issue. What was your business like then?
So I could have taken 2009 off because no one had money. They're like, we can't give you money because we don't know where our money is right now. A lot of them at the time were making commitments to venture capital and private equity. And so those companies had the rights to call this money that they didn't really have. People were selling a lot of their stocks because they needed to come up with funds. 2008, 2009 was tough. Also, because I get paid a percentage of what my manager makes, my 2009 check or whatever was 40% of what my 2008 check was. So I'm along for the ride. Like when I'm telling someone invest with this person, I am, along for the ride with you. If they do poorly, I do poorly.
I love the model of, a venture, relationship. As you do better, I do better. And our whatever, our motives are aligned, right? For this to do really well for you. So I really like that. Did you always have that model, or did you kind of evolve into that?
It's something that a lot of investors like to see. They want to see a manager that's eating their own cooking, so to speak. So if you're running an investment strategy for them and you only have 10% of your net worth in it, they're like, why don't you have all of your money in your own? Do you not believe in yourself, kind of thing? And so historically, the managers I work with, and to be honest with you, it's probably not the greatest thing in the world, because they're running investment strategies that are kind of an outlier and have a chance of producing great returns, but can have bad years. This isn't ever going to be 100% of an endowment portfolio. The managers I work with, it'll be 1 or 2% of their portfolio max.
Right.
But they expect the managers I work with for it to be 100% of their portfolio, because, you know, they're not going to do anything dumb at that point. You know, everyone needs to be concerned about capital preservation. It's an interesting thing in the investment world. There's a lot of different fee structures, and you know, there's 2 and 20, which is kind of a standard hedge fund structure where you get 2% just to kind of keep the lights on, and then you get 20% of the outperformance.
Yep.
And there's situations where a lot of folks, well, I'm just gonna not charge any management fee. I'm gonna be free, and I'm only gonna charge on outperformance. And they think that's a great model, right? Our incentives are aligned. I only make money if you're making money. You don't have to pay me anything. The problem with that is, and I tell people, because I get people coming to me like, what do you think of this structure? I give a lot of early managers advice, and I don't like that structure, because if you underperform the first year, okay, you're kind of footing the bill for everything. If you underperform the second year, you know, same thing. You haven't made any money because you haven't outperformed. Or even if you just perform the same as what you're supposed to, you're still not making any money. And then on the third year, all of a sudden, you're shooting for the moon and rolling the dice and taking big risks, because you have to in order to make up for the previous 2 years. So incentives become very unaligned quickly in that environment. So there's things you have to watch out for.
Yeah, I love that, and it might not just be the 220 model, right, that I've experienced in venture. And I've seen a lot of venture groups or hedge funds go, hey, we're not charging management fee, but they're still paying for their light bills. They're still paying for their admin, their analyst. And then when the things don't pop up, they have to lay everybody off real fast, right? So
Yeah.
nobody's getting rich on that 2% unless you're managing, you know, hundreds of millions of dollars.
And that's a problem too, because what
Yeah.
happens is the big firms, the folks who apply to be, you know, the pension consultants of the world,
Yeah.
they're not looking for outperformance. They're just looking to not lose money, and no one gets fired maintaining the status quo. We call them closet indexers, because eventually they just buy everything and they perform exactly like the market, and they keep their 1% management fee on the billions of dollars they're managing.
Yeah.
And so, yeah, that's a problem in the industry. But you know, the smartest folks on the other end of the table realize this, and so they are looking for these smaller, quirkier managers, 1 or 2 people shops, who are doing something different, who aren't closet indexers. In fact, the furthest thing from it, because for, you know, to get a differentiated result, you got to do something different.
You have to do something different, right? Exactly. Or just throw your money in an index fund, right? If if that's the game you're
And
playing.
a lot of them do that, and a lot of them, it's the smart move. Yeah.
Yeah. When you're working with these groups, right? You started out, you know, from 3D animator. Now you're pitching to, you know, huge endowment funds, right? Total change. If I could think of any total opposite change in the world, you are it, right? So you're pitching. What was the first big check that crossed your plate where you're like, oh gosh, I haven't had a paycheck in a while. Here's the present, and then you see one pop across the table. What was the first big one?
It was, you know, it's funny. I hadn't landed an account over $1 million. I'd landed a few little small 100K accounts, but the first big account was a $10 million check from a large endowment out of New York. You know, if you've ever heard, you know, a sponsor of NPR, chances are I've met with all of those folks, and it's a name we'd all recognize. And they came in and they were very brave, and fortunately, the manager, you know, knocked the ball out of the park, and for the next decade, you know, put up great numbers for them. He closed. They got some of their other friends involved, universities, things like that, and so we closed that manager up. And for the next, you know, 2 decades, really, he hasn't been open and has compounded money for these guys at a great rate.
Why would a hedge fund manager close their door? Why would they, you know, not just keep going? Hey, keep bringing money in.
No, it's tough to do, and that's where the integrity part of being a manager comes in. Because I'll give you a real simple math here situation. Microcap companies are typically companies below $300 million in market cap. Okay, so they're these small companies, typically below the Russell 2000 if people are familiar with indexes. So let's say you have 10 of these companies that are $100 million market cap each, and you're managing $100 million. Okay, so you manage $100 million, which means you're putting $10 million in each of these 10 companies. That means you own 10% of this small microcap company. Okay.
Wow.
It is sometimes hard, A, to get that much. B, maybe you shouldn't be getting that much. If something goes wrong, it's sure as heck hard to get out of it. Sometimes microcaps are called roach motels. I don't know if you grew up in there, when TV ads were of roach motels, the roaches can get in, but they can't get out. Sometimes that's how investors feel with microcaps. You can buy into them, but if something goes wrong, who's going to take your shares from you? These aren't like Tesla or Netflix or where there's thousands of shares trading a day. So if all of a sudden you're owning 10% of 10 companies, there's two things that you can do. One, you can buy bigger companies. If the companies are now 200 million, you're owning 5% of them. You can buy more companies. If you have 20 companies instead of 10, you still only own 5% of each company. Or you can buy bigger companies. And the problem is as you buy bigger and bigger companies, there's more competition, right?
Mm-hmm.
And so by closing your doors early, what you're really doing is opening up a huge opportunity set with no competition. And so that's kind of the beauty of these microcap names. You have thousands of opportunities, very little competition. It's like a fishing pond stocked with the biggest fish. But the problem is, everyone wants a big boat. and if you're willing to sit in your little rowboat, you can catch fish all day.
Yeah.
But everyone wants a big boat. And so the best problem I have is that I do well for my managers and they close and put me out of work. And then I'm on to the next manager who hopefully I can do the same thing for. But it's pretty much a requirement at this point that I'm looking for managers who say, I'm going to shut the doors at this point because that's what's best for investors. And I'm always looking at people from the investor's perspective.
And now you're coaching emerging managers and you're seeing all sorts of cool stuff pop up with blockchain and crypto and all this stuff, right? Like NFTs and things that I have no clue what are. Most of them are, right? But like
most people don't.
Even they don't.
Even the people in the industry. Yeah.
When you're seeing that and and they're going like, hey, we're not going to charge a management fee. Hey, we're open up forever for, we'll raise money till we drop, right? You say you spend a lot of time coaching them. Do you show them from an investor's perspective of why they should do this, why it benefits the investor to charge an investment, fee or a carry or a management fee?
Yeah. No, definitely. A lot of folks, I mean, if I can catch someone early in their life cycle to where I can make a fundamental change that will help them raise money when they hit that 3-year mark, when they have that $5-10 million. Because what you don't want to do is all of a sudden you get 3 years down the line and you have to change your investment strategy.
Totally.
And then all of a sudden people are like, well, that track record that you just built is no good because now you're doing something different. So yeah, I do a lot of coaching and pitch books. I mean, people, the biggest thing with the pitch book is you get 2 slides, I tell people, to get their attention. I mean, these people see thousands of decks. There's more hedge fund managers than stocks, I think. And so by the time you get through these pitch books, I say you have 2 slides and you have to tell them what's unique and different about you. What is your edge? What are you doing that no one else is? And if you can't get it across in 2 slides, they're not going to pay attention to the rest of anything you say. They just don't have the time for it. Yeah.
Yeah. When people come to you, what's a red flag other than, maybe fundamentally they're just a bad person or you see dishonesty or they don't have the right business model? Like what are some red flags that you would say, I would not help raise money there or co-invest with that hedge fund manager?
Yeah, I guess one of the big things is when they're focused on how much money they'll make. That's a big red flag for me. I the best people in this industry, I mean, I find some quirky guys they could care less how much money they make. This is a game that they are passionate about and they want to win. And so what I want is a guy, a person who can talk for an hour about a company. And then I can talk to them a little bit more and they can talk another hour without repeating themselves. I mean, these people live for this stuff. And whether they were managing their own money or managing money for other people, they would be doing the same amount of work. And those are the people I look for. And that comes across in a meeting usually. And then you have people who are like, well, I got out of college, I didn't know what I wanted to do. I, studied business. I'm going to start a hedge fund. This is, ESG is hot right now. Let's start an ESG fund. Those folks, I had 2 managers, a team approached me the other day and they were like, we got this ESG fund and it's, and it's hot right now and we're going to raise money. I'm like, yeah, but what's your investment strategy? And they just couldn't really, explain, well, we're ESG, we invest in these, socially conscious companies and everything. And that's great, but ESG is an opportunity set. It's not an investment strategy, and your opportunity set is actually smaller than everyone else's.
Yeah.
And so it's, that's great if you can have some sort of edge, and definitely a lot of money is going into that space, as it should. I think it's great, but you really need to have a differentiated investment strategy, and it can't just be the latest buzzword.
Yeah.
So those people didn't even make it past the LinkedIn chat of like, will you work with me? I was able to filter that one out within 2 questions. And it's not because I don't like ESG, it's just because they didn't have a defined edge in that space.
Right.
Yeah.
ESG, diversity, impact. We're of this fun, and they'll, maybe 20 different keywords that they're throwing out, rather than here's our business model. Here's how we're going to make your client some money.
Right? Yeah, and it was even worse in blockchain. No one knew what they were doing there. Yeah. But luckily, I worked with probably one of the most reputable firms who went on to do great things, and has been kind of turned into a venture capital firm at this point, backing some of the biggest crypto projects. Cool. So I was fortunate, and not fortunate. I mean, and you do your research and you make sure you team up with the right folks. And so I was fortunate to work with a very reputable firm that is now managing billions of dollars in the crypto space. And when I started with them, they had 5 million. So
super cool. As you're doing this, right? Like, you had to learn what a hedge fund is, right?
Yeah.
You're doing animations and video games and such, and you're like, hedge fund, family office, private equity, like what are some of the, because you work with a lot of emerging funds and growth funds, like what are some of the differentiations between the different groups? Family office, hedge, private equity, venture capital. Maybe could you give us an overview of that?
Yeah, so family offices are great. I kind of categorize family offices into 2 different categories. For those who don't know, a family office is a giant pool of money. Usually a founder has started a business and sold it and sitting on tens of millions of dollars at that point. And rather than give it to Charles Schwab, they say, we're going to, start up our own, I'm going to hire some smart people and they're going to manage my money for me. And you have multi-family offices where they pool families together to kind of save on expenses and hire the very best people. And so family offices kind of go into 2 camps of one where the founder is still involved. And those folks tend to be a bit more adventurous and risk-taking and appreciate entrepreneurship. And you have some family offices that have been around for decades or even centuries. And they are more like, I just want my check. And we have, at this point, 100 descendants, and we just need to keep the money flowing. And they're probably less likely to invest in an innovative, disruptive kind of strategy. But yeah, so family offices are interesting. Right now, one of the areas that's been hot is private equity and venture capital, as you've referred to.
Yep.
And I would say that, for example, this last year, Washington University, an endowment, they produced a 65% annualized return.
Nice.
Which is just ridiculous. Like, it's one thing if, your brother did it, getting lucky investing in Apple stock. But when you're the size of a billions of dollar endowment, to basically increase that by 65% in a year is crazy. And they did it through a lot of venture capital investments that finally paid off, private equity, things like that. And so everyone's trying to imitate that model. It takes a while. Some of these venture capital bets are things that, they placed 5-7 years ago.
Right.
But everyone wants to do that. If you look at the allocations of big endowments, like if you have over $1 billion, you probably have 30% in private equity and venture capital. Whereas if you're a small foundation or a family office with $50 million, let's say, the research shows that they have less than 3% in private equity and venture capital. And the reason is that there's only so many good private equity and venture capital firms. Everyone knows, Andreessen, Union Square Ventures, the big names that are getting into the Twitters and the PayPals. But not everyone can get access to those. And historically, the math kind of works out. If you're not getting into one of the top quartile private equity or venture capital firms, you'd be better off not investing at all in that asset class. And what's interesting about the microcap space that I pitch is that it's a good proxy for this. You have these small companies that are capable of doubling and tripling. It's hard for Procter and Gamble to triple, but these little small $100 million companies can double or triple. And so folks who may not have access to the best private equity and venture capital firms, what's fascinating is the largest endowments, the Harvards, the Yales, the folks who have tens of billions of dollars, they can't always invest in my managers. My current manager I'm working with is closing at 150 million. Yale's smallest check is probably 150 million. They can't even look at my, he would take up 100, they would take up 100% of the capacity of my manager. So they can't look at my guy, but you know who can? Small family offices, smaller endowments. It's one of the places where being small is an advantage because you can invest with the managers that I represent that put up great numbers, oftentimes venture capital, private equity type numbers. Because they're investing in the same types of companies. I mean, private equity companies are going after the same companies my managers are going after. They're just public when they're doing it. And so it's one of the few places family offices and smaller endowments can get an advantage over the big guys. And so yeah, it's kind of interesting. Everyone wants VC and PE, and I'm like, oh, come over here. We have the same things. You just can't give us a ton of money.
Yeah. Hey, that works too when it's just like, no, I can't take that much, or no, like turning away. Where other groups are like, as much as you have, how much is a check? One more dollar, right? Like, give us everything.
Well, and from an incentive standpoint, like trying to land business, I would say that is one thing that's good is that I've gone to folks with a manager, and when they've come back and been intrigued, I can say that manager is closed now. And so there is this fear of missing out. There is an incentive to act. Whereas if you're taking an endless amount of money, the people on the other side of the table can sit there forever, follow you. We'd like to see a little more track record. You're never going to close. But if they know you're going to close and you're going to do this really cool thing that only certain people get access to, they're often more inclined to at least give you an early look so that they don't miss out.
Give you a little look-see, right? Here, take a look at this.
That's all I asked for. Yeah.
So as you're doing this, I clarify for us private equity versus hedge, or venture capital versus hedge, right? Let us understand a little bit more of the business model of a hedge fund.
Yeah, so hedge funds typically invest in public companies, so stocks that are traded on the New York Stock Exchange and the Nasdaq and places like that, and they trade in and out every day. And if you're into a company, you can get out of it if you can find someone to sell your shares to. Private equity oftentimes will take a business and buy it out and kind of own that company or own the majority of it. Sometimes they'll take a public company that is trading shares and they'll buy it out and remove it from the stock market. They'll take it private. And the reason they do that is, A, it's expensive to be a public company. It costs about $1 million in reporting. And also, if you have a longer term vision where maybe you need to switch things up. Public companies have to report quarter to quarter. And so it's hard for them sometimes as they're trying to grow and disrupt things. They're going to have some bad quarters and the stock's going to get punished. And so oftentimes a private equity company will take a company private, do all the messy work, and it'll emerge like a phoenix as a much better company, at which point they'll take it public again, with the new business model. So that's private equity. And then venture capital, there's various stages of venture capital. There's seed stage, there's, A rounds, B rounds, it goes on and on. But essentially what they're trying to do is find little startups, get a, percentage of the company, 5, 10, 20% of this company, keep them on their feet, keep feeding them money as they've proven they can continue to grow and acquire customers. And a lot of times venture capital you think of as being associated with the tech space, not always. But these are companies that if they take off the Twitters, the PayPals of the world, then you're looking at these, they measure their returns not in percentages, but X. Like, we 30X'd our money on that one versus we made 30%. But they also, 19 out of every 20 of their investments probably don't. So it's a much riskier investment approach. And it's part of the reason you don't see average investors investing in venture capital.
Yeah.
You have to have a lot of bets to kind of diversify away the risk.
There's a book that I read called, it was by Basil Peters, called Early Exits, and it talks about the venture model, right? Great book. Canadian venture guy wrote it maybe in 2008. Like, it's an older book, but it described the model. Super cool. What books would you recommend to learn if someone wants to learn cap raising or the hedge fund world? Like, what are some books, and why did you choose hedge funds as your, focus?
Yeah, it's probably mother duck syndrome. My buddy who was running one came to me and said, hey, join on. And I saw that was a great way to do things. And so since then, I've been kind of like looking for other things like that. It's like, oh, I know this works. So I found a niche, and over the years, people know I'm associated with that niche, concentrated microcap managers. So I have managers who run those strategies coming to me, and I have endowments and foundations who are interested in those types of strategies coming to me. And so all of a sudden, you're like, okay, I'm in this little tiny spot. It's in the investment world, I am as small potatoes as they come. I mean, I talk to people in the industry who laugh at what I'm doing because it's like picking up nickels, it's in this world. But at the end of the day, it's enough for a guy working out of his house to do well. But yeah, so I would say books, it's interesting. I mean, I'm fascinated by personal finance, and I think people need to understand the whole breadth of personal finance. The same guy, David Swenson, who wrote that book for how endowments and foundations should manage money, which is a great book, Pioneering Portfolio Management. But I would say that he wrote another book called Unconventional Success, which is probably more appropriate for the folks listening to this. And it discusses, okay, here is what real estate is and why you should have it in your portfolio. Here is what a T-bill is and why you should have it in your portfolio. Here's why you should have exposure to international, emerging, venture capital. And he breaks out all the asset classes and how an average investor can get exposure to them. And I would say, not only do your average retail customers could benefit from this, a lot of endowments and foundations would probably do better than trying to be too fancy. And they could take that same, strategy and approach and asset allocation model and apply it to what they're doing.
Yeah, and it is. I just looked it up. It's on Audible
Oh
and
yeah.
Kindle, or you can get it hard copy by David Swenson.
Yep,
Awesome.
with an E. Yeah.
Okay.
Don't misspell that one. I accidentally misspelled his name when I pitched him, and yeah. that makes an impression one way or another. Yeah.
Read your book. I love it. And he's like, you spelt my name wrong. You're like, oh,
right. And then, oh, gosh. Yeah.
Yeah. What does success look like for you? Like, why? How far? How long are you going to go? Are you going after a full billion? Like what's your goal?
I like finding managers who are doing things the right way and helping them succeed. It's kind of weird. Like I will make money if they succeed and stuff, but I see some of these people who are really passionate and ambitious, and you kind of feed off their energy, right? I don't have the energy of a 25, 30-year-old hedge fund manager who's spending all of his nights reading quarterly reports. So I kind of tap into their energy, and I want to see if they're doing things the right way and they're honest and they're not out to make $1 million. Those are the people who end up making $1 million. And so I like to help them get there. And I gotta tell you, endowments and foundations and universities, it's a great audience. I'm generally not making a rich guy richer. My clients are building libraries in Africa. They're, curing cancer. They're, doing all sorts of things, preserving nature. So I've got, when I go to sleep at night and my managers are making money for these folks, I feel good, and they feel good. And so it's a good part of the industry to be in, because Lord knows there's in investments a lot of shady, scummy, awful parts to be involved in. And fortunately, because of my buddy kind of brought me in at the highest level, I got to avoid a lot of that, all of that, really. I just was fortunate, and not everyone is. There's dark corners of the investment world where people are trying to take advantage of people. And fortunately, everyone on the other side of the table I'm pitching to is so much smarter than me. I could never bamboozle them if I wanted to. So yeah, it works out okay.
Yeah. Now you mentioned when I go to bed at night, I could sleep, sound. In this world, the world that you're in, what does keep you up?
Yeah, I'm fortunate to not be an investment manager, because those are the guys who really lose sleep. They don't want to lose their clients' money. It's funny. I represent them. If they blow up, I can move on to the next guy. If they blow up, it's 5 years of their life.
Totally.
It's all of their money. So they're probably losing more sleep than me, which is comforting, because I know that they're concerned and they're going to do their very best.
Yes.
And so partnering with the right people who have a downside protection mindset, especially in a riskier part of the market, that's a huge deal. Like, that's number one for me, is I'm looking for people who think about not losing their clients' money, not how much money they're going to make. When you talked about red flags, typically in my first meeting, I generally get a sense if these people are worried about losing money, and that's what you want to see. Yeah.
Have you seen the show Billions about the hedge fund Axe
Yeah.
Capital? All
It's
right.
awesome.
It is so good. Okay, cool. All right.
Yeah.
We're brothers. All right. In
Yeah.
that show, who do you mostly relate with?
Oh gosh. I imagine myself being the much cooler people on there, but yeah, I'm just it's not nearly that exciting. The crypto investment world, when I was in that, it was a little bit more exciting.
Yeah.
But with the traditional investment strategies, they're looking at your number, looking how volatile you are, looking at your downside protection. There are no magical formulas that cause hedge fund managers to outperform everyone else unless you're cheating, which over the years, there have been people who cheated. I lost money to Bernie Madoff once. I remember back in early 2000 when I was pitching a management firm, a multifamily office, as it were. And they were impressed by us, but this other guy had way better returns. And
Yeah.
I found out at the end of the day that they
was-
gave money to Bernie Madoff and they blew up. They're no longer in existence. And all those people scattered to different jobs. Yeah, no, it's, no, my guys, to be honest with you, the asset class and the sector of the market I'm in is fairly exciting as far as investment world goes, because a lot of people are investing in bonds and Fortune 500 companies. It's boring. I have tried to represent these large cap value managers, and it's just like, oh my gosh, I can't do it. I can't get excited. Like, how are you going to outperform Warren Buffett? And to be honest with you, Warren Buffett's had a hard time outperforming the S&P 500 over the last decade, and you're going to come along and. So a lot of these folks who are investing in areas where it's really hard to get an edge or an advantage, I can't sell them because I don't believe in them. I've had a lot of folks approach me that I'm like, this is great, I wish you luck, but I don't believe it's going to work, and I hope you prove me wrong.
Yeah.
And a lot of them do, but yeah.
Super cool. I got some questions I want to ask you. All right.
All right.
Tell me when to stop. I've got some cards of questions.
Oh, pick a card right there, anywhere there. Yeah.
Yeah. I outsource some of my questions to smarter people who write it on. Okay. Okay. What do you appreciate about the culture that you grew up in? All right. So you graduated in the 90s, right?
Yeah.
High school
in
the 90s.
97. Yeah.
Okay. So what
do I appreciate? Yeah. I would say I grew up in Omaha, Nebraska. And I would say, everyone up there grows up as I've mentioned Warren Buffett a number of times. It's because everyone up there is indoctrinated into value investing and everything. But I would say in general, Nebraskans are fairly financially conservative. And people who had credit card debt, that was like shocking to me when I found other kids who had were in debt. I'm like, you don't buy something if you can't afford it. It's like, you work, you save the money, and then you buy it. How are you? It blew me away that this stuff even existed. And there are people out in California who everything is on credit, and you're taking other people's money and rolling the dice with it. And that mentality has been really hard. I live in Austin, Texas now, so it's a little more venture capital, a little more adventurous. But my roots are definitely financially conservative. Rule number one, don't lose money. Rule number two, see rule number one.
Yeah.
And so I would say, and then the honesty and integrity of folks in the Midwest. I don't, the niceness. I mean, Nebraska's slogan is Nebraska nice, and I think it fits. Yeah. I think I have run into people in Wall Street who are exceptionally cocky, exceptionally flashy. And, that doesn't fly in my world. I'm not impressed. And so, hard work and integrity are what impresses me. Yeah.
Super cool. Have you seen the SNL skit, Don't Buy Stuff?
Yes.
It's so good.
That's awesome. Just don't buy stuff. Yeah.
Wait a second. I don't think I understand. So if I can't afford it, don't buy stuff? Yes.
Yeah.
No,
yeah.
I don't get it. It's so good.
And it's tough. It's easy for me to say that. I was able to, I had a good job in college. I was able to put my way through college. I think the cost of college has tripled, since that time, and
Yeah.
salaries have not. So I really feel for these young college students, because you can't just work at Wendy's and put your way through college.
Oh
They're in
man.
a tough spot. So
Yeah.
yeah, it's oh, the golden days were so great and everything, but they really were from a financial perspective. And heaven help you if you're a millennial trying to buy a house. It's
Oh
they're in a
Lord.
tough spot. Yeah.
Oh yeah. Oh yeah. So with that, what advice do you have? Not investment advice, because you'll
Mhm.
have to do 4 pages of disclaimers, and we just don't have time for that. What advice do you have for emerging fund managers, hedge funds, guys who are trying to raise some capital? Like what's a good practice that they can adapt,
I think keep at it.
adopt?
If you believe in yourself, that's the most important thing. A lot of people want to take the easy money. There are firms out there that will do some incredible deals for a firm to take a percentage of ownership. All right.
Hmm.
Like if you're not managing any money, they'll give you your first couple $1 million. Okay. And they will take a big chunk of your firm. And then, depending on how much time, I mean, if you're early on in your life cycle, perhaps, but if you've put in 3 years already and you're getting frustrated because you're not raising money, and that's when, I don't want to say the vultures, because I mean, it's a useful business model for people to come in and they'll say, tell you what, we'll give you $1 million, and you put up 100,000 of your own money, and the first 10% of losses are yours, not ours.
Hmm.
And a lot of people will take that deal. And the person who put up $1 million, they just get a margin of safety of 10% loss on this manager. And the manager is willing to do it because now they have $1 million. So now they can go out and raise another million, because it takes money to, raise money. And no one wants to be a large part of a manager's portfolio. So yeah.
You just mentioned something. It takes money to raise money, right?
Yeah. Chicken egg.
Which
My
came
whole
first,
world
the
is chicken
chicken?
egg.
Yeah.
Yeah, because you need the
Explain
money to
that.
get the money. Yeah, it's so in general, an investor doesn't want to be, say, more than 20% of your assets. So if you're managing $10 million, you might get a $2 million check from someone. And part of the reason is if they come in with a $5 million check and then it doesn't work out and they pull that money, they feel like they're bankrupting your business and putting people out of work and all that. Generally, that's not the case. I tell those people, believe me, we'd be doing a lot worse if we didn't have your money. I'd be happy to have a $5 million check. But a lot of folks don't want to be a large percentage of your assets. They also want other people co-invested alongside them. And so, yeah, I think that's, so you got to slowly build the money over time. And every million you get, it just makes it easier to get that other bigger check. And when you get to 20 million, then you're getting $5 million checks. And so you slowly have to build up there. And it's very hard for managers to get there. It's the first number of years are a slog. Some managers get there through appreciation. If you put $1 million of your own money in that you saved doing whatever, working on Wall Street, and you started your own firm and you grew it to 3 million, that's one way to do it. It takes a lot longer usually. If you're earning 10% a year, it's going to take you 7 years to get there. So yeah, that first money is the hardest, which is now where I try and find people with a little bit more assets, 5 million, 10 million.
Mhm.
Maybe they have a family office, maybe they have some other money from somewhere, to kind of get them started, because that money is hard to get. And I empathize with all the guys who are starting a business, because that's the hardest part. And you know what? They're not marketers. They're not supposed to be marketers. They're
Right.
supposed to be in the back room with the green eye shade on, looking over, quarterly numbers, doing research. And part of my role is, as you can see, I'm rather talkative, but a lot of these people aren't. And so
Yeah.
they need someone to represent them. And yeah, and in some ways too, you don't want to go up and tell the world, hey, I'm the Tom Cruise of investing. No one's, if coming from an investment manager, that's going to come off wrong. But if I say this guy is amazing, you can say that sort of thing, and it comes across a little better. And hopefully at this point, I've got a good idea of who the amazing managers are.
Do they still wear those green visors with abacuses growing in the background and doing
Well,
calculations?
I don't have anyone using abacuses, but I did have a guy who had 30 file cabinets, and he had every he had ads from a men's clothing store going back 20 years, so he could see the progression of. Yeah, you get some interesting folks in this industry. When I say I like quirky guys, but in some ways there's something wrong with people, but in a good way.
Yeah.
And a lot of these people are extremely funny, intelligent, but their brains are wired differently than most people.
Yeah.
As the marketer, they're definitely wired differently than mine. And so that's another thing. A lot of these folks, may not be good people, and so I help them out, and I can relate to everyone. I get along with them.
That's super cool. Two more questions. One,
Mhm.
how can people reach out to you, especially emerging fund? They have 5 million. They
Yeah,
have a niche market. They're concentrated, hedge, and they want
yeah.
to connect with you and maybe do a deal. Where's a good place for them to connect with you?
LinkedIn is a great spot. I'm Maury McCoy, Maurymccoy. On Twitter, I'm also at Maury McCoy. The nice thing about having an unusual name is I was able to get, all of the handles I wanted. So yeah, Maurymccoy. My company's name is McCoy-Associates. And so there are no associates. I've got a couple pets running around here, but at the end of the day, that's a great place too, McCoy-Associates.com. I'm Maury at McCoy-Associates.com is an email anyone can reach out to me. Yeah.
So I lied. I have two more questions. When people mispronounce your name, how do they
Yes.
mispronounce it?
Murray, often. Yeah, it's
Murray.
funny. More. I always tell people Maury like Povich, and Maury Povich just canceled his 30-year run show. So I don't know what I'm going to tell the next generation to tell them how to pronounce my name. But yeah, it's Maury. Yeah.
Maury. Okay, got it. Because before the interview, I was like, was it Maury? Was it Murray? I was like trying to run it through my head. So I was like, I'm going to call him Mr. McCoy.
You know what? I struggle with this, and especially with names from cultures I'm not as familiar with.
Yeah.
LinkedIn added the feature where you can input how to say your name.
Oh, yeah.
I have done that because I realized Maury is kind of tricky, but there are some names. I mean, obviously, I'm. Oh gosh, it's a struggle sometimes. Yeah.
You're like, hey, you.
There's a lot of really smart people who have come to this country and work in the investment world, and
Yeah.
yeah.
Super cool. Last question. What question should I have maybe asked you that I screwed up and didn't ask you that you want to talk about?
Nothing. I think I hit on almost everything. You know, I I would say it's not all roses. There are disadvantages to the types of people I work with. They're smaller. They don't have the financial resources. Operationally they don't have a travel department. It's a struggle, and it's kind of these are the things you put up with. I kind of consider them barriers to entry for other people working with the managers I want to work with. And everything that's frustrating, I have to just think that that's one other person who's, gonna bail and not continue on. And my managers feel the same way, the ones I work with. So it's a struggle. This is not, there are people in my industry who are going out and, meeting with the pension funds of General Electric and managing, landing $100 billion checks, and boy, that would be nice, but that's not what I do. I found this little niche, and I grind away, and it is a grind. I mean, this all sounds good. I'm raising tens of millions of dollars, and I work with crypto asset funds, and what people don't see is that the majority of my day is researching people, sending out emails that might connect with them, trying to find folks who are interested in this sort of thing, because they're few and far between. But the ones who are really, really get excited when I bring them a manager, and that makes my day when I'm connecting those rare people on both sides of the table who want to meet each other. I'm the Tinder of the investment world, as it were. So yeah,
Oh, swiping right for
yeah,
capital.
yeah, right, yeah,
Awesome. Well, Mr. McCoy, Maury, thank you for
yes,
being on the show. Did I said it right? Right? Yes.
yes, Maury, yeah.
Yay! Awesome. Well, thanks for coming on the show, fellow deal makers in the audience. As always, reach out to our guests. Say thanks for being on the show. If their services match what your needs are, reach out to them and say, hey, let's do a deal. That's the purpose of this show, is to connect deals and deal makers. So if you're working on something or want to talk about it here on the show, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, talk to you all next episode. See you guys.
All right, thanks, Jeff.